It's now time for Jerome Powell's speech. Let's go and listen to what Jerome Powell has to say. Here we go.
A year ago, that's a big change. I'd say risks are coming much more into balance now.
President Campos, you have been on a different journey because you've actually been cutting rates for much of the last year and have recently paused. Why? What are you seeing in inflation data, and what are you going to do next?
Okay, so if you go back a little bit in the history of time, so Brazil was one of the first countries to hike rates. I think in part because we had a different call on the dynamics of inflation, both locally and globally. And I think that turned out to be correct. And then at some point in time, we started the easing cycle. And throughout this process of easing, we've seen that inflation has converged. We have some of the problems that are common to advanced economies and other Latin American countries, which is labor markets very strong. So there were 2 points of attention. One was labor market being that strong, would that at some point in time mean inflation in the service side? And even though we haven't seen that yet, what we try to do is to try to estimate what would be the components of labor in every service so that we can anticipate if that were to happen. We haven't seen it, but we think it's, there is somewhat of a correlation when you look at the margin. And so most recently we decided to pause. That had to do not only with the current numbers and with this suspicion that we had service inflation that could peak at some point in time, and also because food prices were going back up a little bit, and I also think that's not only happening in Brazil, it's going to happen in some other places too. But also has to do with a lot of noises that we had. So we decided to interrupt the cycle. More recently, we've had a sell-off in some of the emerging market countries. Brazil was more affected. But I think this has to do much more with noises that were created than the fundamentals. And the noises are related to 2 channels. One is the expectation on the path of fiscal policy, and the other one is expectation on the future of monetary policy. So when you had these 2 at the same time, I think it created uncertainty enough that for us, we needed to interrupt and see how we can fix that channel and how we can communicate better so that we can eliminate those noises. Because there is a big disconnection with the current data, both fiscal and inflation data, and the expectation. So what happened in Brazil is the expectations started to de-anchor, even though the current data is coming as expected.
Right. So you're talking about the fall in the stock market and the real recently when you talk about the markets.
But for us, what matters is how this gets into our reaction function. So I'm talking about expected inflation, the long end of interest rate curve. So we had somewhat of a steepening of the interest rate curve. We had a devaluation of the currency. But for us, what matters is the expected inflation, both implied inflation from the markets and expected inflation from the surveys. Those have gone up.
Yeah, I mean, President Lagarde, you have described the path to 2% as bumpy. We got an inflation report in the Eurozone this morning, 2.5%, not too bad, but core was high and services are still above 4%. So what is keeping prices so sticky?
Well, first of all, we had, as you said, a number that was lower than last month. So we said it was bumpy, and it's proving heading in the right direction for the indicator that we use, which is HICP, to measure inflation and to set our target. So that's good, but we still believe that it's likely to be a bumpy road until the end of 2024. But we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front. You are correct that services hasn't budged. So services is at 4.1, if I remember from the numbers that we got this morning. And obviously we are very attentive to the components and what is behind services. And the real issue is to understand whether those are, this is caused by sort of permanent changes, or whether it is also a factor of the lag effects of other components which are finding their way more slowly and gradually into services. And the jury is out as to exactly what it is. the truth of the matter is that we do have a service number that has gone slightly up in the recent months, and which is now staying at this 4.1 percentage points. Now, obviously, we don't need to have services at 2% because manufacturing goods are below 2%, and at the end of the day, it's going to be a balance between goods and services, and it depends on the weight of those within the index. But we have to look really what is behind it, and what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe, where clearly bargaining agreements are negotiated not only on an annual basis in some countries, but sometimes on a triennial basis in other countries. So you have this catch-up effect. For those people whose renegotiation took place early this year, they had not had a negotiation of wages in the last 3 years. In the meantime, of course, inflation went up and their real wages went down. So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window, and services are also going to be on a declining path as well. But services is the difficult one.
I was just going to pose that Taylor Swift is touring Europe this summer, and there tends to be an inflationary effect in services. Am I right, Chair Powell? We saw it last year, didn't we?
It's not just Taylor Swift, others have come as well. Larry Spring, yeah.
I don't know. I saw her at Wembley, and there was a lot of spending going on. No, but how do you look at the services, the stickiness of the services inflation, and how tied it is to
what a silly
wages,
comment that was,
which have been rising?
Famously, services inflation is stickier, and famously it's tied to wages. I would say, so look at the U.S. labor market. We've seen a pretty substantial move toward better balance than we had a couple of years ago when labor was in extreme shortage. So what you see now is an unemployment rate that's moving back up toward a more sustainable level. You see wage increases moving back down toward a sustainable level of wage increases, inflation, and productivity, and you see, vacancies to unemployment ratio coming back to where it was pre-pandemic, and so many other measures I could mention. So that's what we're seeing, and so the labor market, wage increases are still a bit above where they would wind up in equilibrium, but nonetheless, you can see the labor market is cooling off, appropriately so, and we're watching it very carefully. But it doesn't look like it's heating up or presenting a big problem for inflation going forward. Indeed, it looks like it's doing just what you would want it to do, which is to cool off over time, not quickly, not suddenly, not steeply. It's kind of what we've been hoping to see and have been seeing. So, and services generally they're such a mixed bag, particularly non-housing services are a mixed bag. Some of what you're seeing is catch-up inflation from inflationary pressures that happened earlier. That's true with insurance. It's also true with housing services inflation, where you've got some pent-up rent increases that have to work their way off. It turns out it takes more than 1 year for that to happen. It takes several years. So we see all that in train, and we don't see ourselves getting back to 2% inflation this year or next year, or maybe late next year, but in the year after. The main thing is we're making real progress.
Can you keep cutting President Lagarde if he keeps holding? Does it make it harder?
Good.
Well, look, I'm going to give you the conventional response because that's the conventional question you ask me. We do take into account the spillover impact of whatever is decided by other esteemed colleagues. And obviously my esteemed friend, Chair Powell, is one of those. So we take that into account, but we also determine our monetary policy on the basis of what we see in our economy. And we look at the data that we get, the impact that multiple factors have on our economies and its numbers.
Does it matter for you, President Campos, what the Fed does next?
Well, I think it matters to an extent, but I think there is one point that is worth mentioning, which is more recently we've seen a sell-off in some of the EM, and especially the EM that had more, there were like more the best cases for investment. And you see that this is being explained with local news. But when you have a lot of sell-offs in different markets and they're all explained by local news, you have to ask yourself if there is a more fundamental factor driving that. And I think there might be. It's difficult to make the case right now, but definitely what we see now is there is more risk premium in a lot of the emerging market countries. And it was very synchronized with the long end of the US curve, and that correlation broke. So we've seen the last couple of weeks that even though the 10-year yield is more or less stable, even actually going a little bit lower, we saw a bit of a sell-off in emerging market countries. And I think that has to do with the fact that as you go for longer with higher rates and much higher debt, you start extracting liquidity from the market, and eventually you are repricing that liquidity. It could just be a temporary adjustment in EM, or it could be the beginning of a more profound movement. We need to wait and see. But I think the correlation between the US Treasury and some of the EM has been broken in the last couple of weeks. And I think we should pay attention to that.
What about the fundamentals in emerging markets? Because the economies seem to do better during this hiking cycle than they have previously. Why do you think that is? And does it continue?
I think most EMs did a better job in terms of, or at least an equal job in terms of anticipating the process and starting the hiking process. Also in the fiscal part, on average, emerging market countries spent more or less 10% of GDP facing the pandemic. Advanced economies spend a little bit more than 20%. So I think there is also this thing which didn't happen in the past, which is by and large, emerging markets were able to deal with the pandemic spending less. And actually, when you look at the fiscal post-pandemic, emerging market continues, it's not the case of every country, but continues to do a little bit better. So I think that also change the dynamics. And one of the things is, I think, the independence of the central bank and the maturity that a lot of the central banks have gained in emerging market proved to be very useful during this process of the pandemic.
I mean, all of your economies did better than expected with the interest rate hikes, wouldn't you say, Chair Powell?
Yes, I think particularly, I mean, many forecasters had a recession in 2023, which not only turned out to be wrong in the case of the U.S., we had well in excess of 3% growth. So,
but you still see policy as restrictive?
Yes, we do.
How restrictive?
Well, so that's kind of an empirical question. So I guess I would say, if you look at, we do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings, and now a slight softening in unemployment in the form of wages. You see demand coming down, not just the supply that we're getting, but also demand coming down. You also see the effects of high interest rates in the housing market and in some other interest rate sensitive things. So you see that, and I think, I do think that restrictive policy is working hand in hand with this broad supply side recovery we've had, where we've seen the unwinding of the shortages and bottlenecks from the pandemic. We've also seen a recovery in labor force participation among prime age individuals in the U.S., and then some immigration, which has also been a positive supply shock. So we've seen all those things work together to give us, really significant declines in inflation. At the same time, we've got a strong labor market and growth. This was it's a great outcome for the people that we serve, and it's one that we want to do everything we can to foster.
So why not just cut rates to protect it?
It's what I said earlier.
Is it a bigger risk? I'll rephrase. Is it a bigger risk that you cut prematurely and inflation stays sticky, or that you wait too long and the economy loses more momentum?
That is the question, and so our answer to the question is we serve a dual mandate, right? And these two things are embodied in that mandate. The risk on the inflation side is that you move too quickly, inflation comes back, and we didn't really solve the problem. and then we have to go back in, and that would be very disruptive to the economy. So the other risk is that we wait too long. We understand that, and the labor market softens too much. Perhaps we lose the expansion. So needless to say, we don't want to do that either. So, but at the same time, so we've got to balance those two. And again, given the strength we see in the U.S. economy, we can approach that question carefully. But as I said earlier, though, you see. A year or so ago, we were talking about inflation, and our framework called for us to focus on the variable, the mandate that is further from its goal. That's not. They've come back much closer into balance, and a good way to see it is the beverage curve analysis that everybody talks about and looks at. We've come straight down the beverage curve, but you're really getting to that place relative to job openings and hiring rates, where traditionally the beverage curve is flattened out, which would mean higher unemployment as a result of further declines in job openings. So you can't know that with precision, but it's very much understood by us that we have two-sided risks and we have to manage them.
What about the recovery in the Eurozone, President Lagarde? It's also been pretty resilient, especially on the unemployment front. How confident do you feel in sticking this soft landing?
Well, we reached a level of confidence back in June when we decided to actually cut rates by 25 basis points. But as I said in the opening remarks, it's not something that is taken for granted, that is a given, and we're going to re-examine each and every step of the way whether that confidence is actually continuously reinforced in order to continue on that path. And the remarks by Chair Powell made me really reinforce my points about data. Because we are navigating in this universe of one risk versus the other, but where data is so important. And data is so important because we proceed always with the burden of the lag of time, whether it's the impact of our policy decisions, whether it's the impact of wages, whether it's the sort of on-time data or not. All of that has to be taken into account and analyzed in details so that we can feel really confident that we can go forward.
At the same time, there are also political risks. Certainly they're front and center. It was nice of all the authorities to make elections all happen this week, certainly in France and in England. President Lagarde, is there anything the ECB can do to shield the rest of the Eurozone from feeling any negative impact from a divided government in France or from whatever the result is of the French election in a negative way?
I thank you so much for your question.
It can't be a surprise.
Because I'm not going to comment on the political situation of any of the member states, particularly those that are facing elections at the moment. But, obviously, the European Central Bank has to do what it has to do. Our mandate is price stability. Price stability is obviously relying on financial stability, and we are attentive to that because this is part of our job, and we will continue to do so.
Does the rise in French bond yields look worrisome at all?
These are the things that we monitor. This is part of the job. It's not particularly at this point in time. We do that all the time, and we are very attentive.
You have fought hard for the central bank's independence in Brazil, and yet now you are the subject of many attacks from President Lula, and so I'm wondering how you're dealing with that.
Attacks from me?
No. No, President Campos. Attacks from President Lula. I think he called you an adversary and an enemy.
Yes, well, I think as a central banker, we have to get away from the political arena and try to go on with the technical job. And I think what we did, is a living proof that everything that was done was very technical. So during the elections in which Lula was elected, the incumbent president, in his last year of mandate, we increased rates in a cycle that went from 2% to 13.75%. That's the biggest increase in rates in an election year in the history of any emerging markets. So if that is not a proof that you are independent and you acted autonomously, it's difficult to find another example like that. So I think all this narrative that the central bank has been political, I think we have to get away from that and explain what we're doing. And I think what we're doing has been very technical. The last decision was unanimous, and we now have 4 members in the board that were chosen by the current president. And I think what we need to separate it was what is the political narrative and what is the technical job that we need to do. And I think history will tell and time will tell.
So there was the Jerome Powell speech, and also listening into the European Central Bank as well. Sorry for the abrupt ending. It just came to an end. It was the feed that was providing it to me just suddenly decided we'd had enough. Quite unusual, really. Anyway, click above my head, down below in the description, and over here for more information. Until next time, as always, thanks for tuning in. Bye-bye for now.